All right, let's talk about one of the most reliable patterns in trading, the flag. Why? Well, because it's kind of like a second chance. It's that signal that pops up right when you think you've totally missed a huge move. So today we're going to break down exactly how to spot this thing and, more importantly, how to trade it.
You know that feeling, right? That pit in your stomach when you see a stock or a crypto just explode upwards and you're not in it? Your first thought is always, oh, I missed the boat. You just feel stuck on the sidelines, watching it run away without you.
But here's the thing, what if it hasn't actually run away? What if the market is just, catching its breath? What if there was a specific, repeatable signal that basically screams, hey, the next big leg of this move is about to start? Well, there is, and that is the flag pattern. It is literally your second chance to jump on board.
Okay, so first things first, and this is super, super important. A flag is a continuation pattern. Let me say that again. It continues the trend. It is not a reversal signal. Think of it as a sign that the trend is healthy, it's just taken a little break, and it's probably about to take off again with some serious power. And I love this quote because it just nails the psychology behind it. When a trend is really strong, it's so one-sided that the other guys, the sellers in a big uptrend, they just don't have the firepower to push the price back down in any meaningful way. So instead of a deep, scary pullback, you get this brief, tidy little pause. The market's literally just catching its breath before the next sprint. But to actually trade this thing effectively, you've got to know exactly what you're looking for. You need to know its anatomy, piece by piece. Because getting these details right is what separates a truly high-probability trade from just, random noise on the chart. So, component number 1, the flagpole. This is the big kahuna, the initial explosion. We're talking about a sharp, powerful, almost vertical price move. It has to look way stronger and faster than whatever was happening on the chart right before it. This is that whoa moment that makes everyone sit up and pay attention. And after that massive flagpole, we get the flag itself. The price chills out a bit, it forms this nice, tight little channel, kind of like a rectangle. But here is the most important part. The flag always slopes against the trend. So if the flagpole shot straight up, the flag will drift gently down. If the flagpole crashed down, the flag will drift gently up. It's that gentle counter move. Now, let's talk about the secret sauce, volume. Volume tells you the real story here. Think it through. The flagpole happens on a massive spike in volume, right? Tons of people are jumping in. Then, during the quiet flag part, what happens? Volume just dries up. People are waiting, they're losing interest, and then, bam, on the breakout, the volume comes rushing back in. That high, low, high signature in your volume indicator, that is your golden confirmation. It's huge. And here's a super important rule you gotta remember. The little flag part, it should not retrace more than 50% of the flagpole's move. Think about it. If it pulls back too far, it means the opposing side is getting a little too strong, right? It puts the whole continuation idea in doubt. So keep it shallow. Less than 50% is the sweet spot. What's really cool about this pattern is that it works both ways. You've got bull flags for when the price is going up and bear flags for when it's going down. And the best part? They're just perfect mirror images. Once you learn one, you pretty much know the other. So let's just look at them side by side here. The bull flag on the left, you get that big move up the flagpole. Then the flag drifts down a bit. Your signal, you buy when it breaks out above that little channel. Now look at the bear flag on the right. It's the exact opposite. A big crash down, the flagpole. The flag drifts up a bit, and your signal is to sell when it breaks down below the channel. See? Perfect mirror image. Okay, theory time is over. We know what it is, we know what it looks like. So the big question is, how do we actually treat it? This can't be about feelings or guesswork. We need a plan, a step-by-step playbook. So let's build one right now. Here it is, your 4-step process. Step 1, spot that big, powerful flagpole. Step 2, grab your drawing tool and outline the parallel channel of the flag itself. Step 3, glance down at your volume. Are you seeing that high-low-high pattern? Yes? Good. And step 4, and listen, this part is non-negotiable. You wait for a full candle to close outside of that channel. I don't care if the price pokes its head out for a second, we need a confirmed close. That's your trigger. The real beauty of a flag pattern is how mechanical it is. It gives you everything you need for a solid trade plan. Your entry point? It's right there, at the breakout. Your stop loss? Easy. Just tuck it right below the lowest point of the flag for a long, or right above the highest point for a short. And your profit target? That's built in too. Just measure the height of the original flagpole and then project that same distance from your breakout point.
No emotion, no guesswork, just a simple, repeatable plan. All right, now let's be real for a second. Even though this is a fantastic, high probability setup, it is not a magic bullet. It's not foolproof. There are some classic traps that people fall for time and time again. And honestly, knowing how to avoid these traps is just as crucial as knowing how to spot the pattern in the first place. So here it is, the million-dollar question. The single biggest risk you face with this pattern. The price starts to break out of the flag, but is it a real breakout? Or is it a fake out? A trap designed to suck in all the impatient traders right before it reverses and goes the other way. So, how can you tell the difference? Well, a real breakout has conviction. It looks strong. We're talking a big, full-bodied candle that closes way outside the channel, and of course, it's got to have that big surge in volume to back it up. A fake breakout, on the other hand, it's weak, it's hesitant, the price just kind of pokes out, usually on really low volume, and then it gets slapped right back inside the channel. Your best defense against this? Patience. You have to wait for the candle to close and see that volume kick in.
Okay, so we've gone through the what, the why, and the how. We've talked about the anatomy, the playbook, and the traps to avoid. So let's wrap this all up into one simple, actionable checklist that you can literally use every single time you think you've spotted one of these.
All right, here's your final checklist for success. 1. Find that strong, high-volume flagpole. 2. Make sure the flag itself is shallow and that the volume has dropped off. 3. Be patient and wait for a confirmed breakout candle on high volume. 4. Plan your entire trade, your entry, your stop, and your target before you get in. And 5, the most critical step of all, execute your plan with total discipline. No cheating, no exceptions. And really, that's what it all comes down to. You have the playbook now. The pattern is right there on the chart for anyone to see. But the real question isn't whether you can spot it. The real question is, do you have the discipline to actually follow the rules every single time? Because that's what separates the pros from everyone else.